Knowledge is Power. Stephen Kaufman is an attorney specializing in senior issues and estate planning since 1974. He's the former Virginia Deputy Commissioner of Insurance, and he wrote the laws on long-term care for the state of Virginia. Steve wants to share with you the knowledge that will give you power. Power to gain control over your financial destiny as opposed to leaving it to the control of the government or others. He foresees that anywhere from 1/3 to 100% of our seniors' 50 years of hard work will be lost in just 1 to 3 years due to improper or no estate planning. We've already paid the government 1/3 to 1/2 of our money in federal and state income taxes, property taxes, and Social Security taxes during our lifetime. Do we want to make the government our heir for the rest of our states as well? We all know we can't take it with us when we go. What many folks don't realize is that they do have a choice. Not to plan is a choice. We can choose to give to our loved ones, or Uncle Sam or the nursing homes will be our biggest heirs, all at the expense of our families. Either you will have a plan for how your estate will be distributed, or the government will have a plan for you. Do you want to maintain control of your assets? Do you want to pay more taxes than you are legally required to by the IRS? Do you want to prevent your estate from being wiped out by staggering nursing home costs or outrageous lawyers' probate fees? Let's join Steve Kaufman now as he discusses these estate planning matters from selected clips of television interviews and workshop instruction that he wants to share with you.
In Proverbs it says a wise man lays up an inheritance for his grandchildren. And when you think about that, yeah, a lot of times the children are waiting for that inheritance, but, well, a lot of times it never gets to the grandchildren unless somebody plans. Steve, what are some of the ways that people could plan to pass their inheritance on to that second or third generation?
This is where it almost dovetails with charitable giving. Right now, the government punishes you severely for trying to take care of your grandchildren. The estate tax today is up to 55%. If you want to skip a generation and actually give directly to your grandchildren, you can be taxed another 55%. I don't know about your math, but 55 and 55 gets pretty close to 100. One way to do that with charitable giving as well is to set up what is called a dynasty trust. That's where your estate could be passed tax-free to your children, giving them income for life, particularly if some of your children have special needs, maybe disabled, maybe you're a spendthrift, maybe you're having problems with society that you don't want to give them large chunks of money. The dynasty trust could keep it in trust, give them income, principal for an emergency, and then pass along some of the estate to the grandchildren. And while many people may not remember their grandfather or great-grandfather, if they're going to get a check for the rest of their life, they'll remember you.
Mm-hmm. Yeah, I've heard you say it's possible to give $10,000 a year to your children. Why would somebody want to do that?
People will want to give $10,000 a year to try to keep the cost of their estate tax down, because you can give $10,000 away each person per year, $20,000 a year to each person if you're married, to try to keep your estate tax down, because this does not count against that $600,000 that we're allowed to give away. And a family with a large estate, let's say has 4 or 5 children and 10 or 15 grandchildren, they can give up to $250,000 a year absolutely gift tax-free. And how a station like this can benefit, you can give within that $10,000 life insurance. That premium for within that $10,000, even if it's $1,000 or $2,000, might buy $100,000 tax-free that you'd be benefiting. The seeds that you can plant for this station to reach something like $100,000 to carry the word, throughout this area. What a wonderful gift.
So there are things that people can start to do while they're living and enjoy giving some of their estate away, yet still have plenty to handle, their own life.
And the beauty of that is you have the pleasure seeing your lifetime gift, seeing your grandchildren or children, buy some wonderful thing thanks to your generosity. You don't have to hoard it all until you die because you'll be penalized, particularly if you have more than $600,000. You can give away huge amounts tax-free each year. And also save that, because if you hold it and then pass it along to your children, they may pay up to 55 cents and even more if then you want to give it to your grandchildren. One topic I'd like to share with you now is planned giving, also known as charitable giving. And when I give dozens of these workshops around the state, I used to advertise them as learn the secrets that the IRS doesn't want you to know to save all these IRA and capital gains taxes and estate taxes. And I got a call from a very close friend of mine that works for the IRS, and he said, Steve, you're wrong. The IRS wants people to know about that. We have all these tax benefits that you know about to encourage Americans to start giving again. And he's exactly right. The IRS wants you to know this. The government is shrinking from Medicare, from Social Security, from social programs, healthcare research, nonprofit organizations. They want to encourage Americans to step in again. The churches, the civic organizations, the communities, the educational organizations to step in and make America great like it used to. The government has taken such care of so many people that millions of Americans have become dependent on the government through welfare. There is a better choice that could, in addition to give you the personal satisfaction of helping a charity of your choice, you can receive a 5-10-fold living benefit right here on earth. And this works for the largest state as well as the smallest state. And I'm going to share with you now exactly how it works in 3 examples. One, an overview, and then I'm going to show you before of people that need income and have to sell property without the benefit of a charitable trust, and then after of how a charitable remainder trust can work. Basically, a charitable remainder trust works wonderful for appreciated property. IRA property, IRA stocks and bonds, homes that you may be living in or may not be living in. It works if you need some income. The tax benefits are enormous, and I'm going to share with you right now exactly how it works. But the concept with a charitable trust is it gives you income tax benefits and income for the rest of your life, and it totally eliminates all estate taxes, and it's just a wonderful situation. How a charitable remainder trust works is you set up a trust, you put the assets in the trust, and at your death, the assets go to a charity. It's that simple. But let me show you in detail how it works. Step 1 is you simply set up the charitable remainder trust. Step 2 is you choose the charity, whether it's a station, a nonprofit station, a Christian organization, your choice. A charity that follows the philosophies that you believe in. Then you become the trustee. You can have a lot of fun with this. You can set up a foundation, and you can travel all over the country and working with charitable organizations. You can have a lot of fun, or you can simply set up the trust and just manage the property. Then you transfer the assets to the trust, just like with revocable living trust. If it's real estate, a deed is prepared. If it's bank accounts, the bank account is put into the name of the trust. If it's an IRA, it works tremendously for an IRA because you can use it for an IRA in 2 reasons. One, if the asset is put into the IRA, there'll be no sale on the no IRA or capital gains tax putting in, or if you want to sell the IRA later, you can escape the IRA and capital gains tax by using the income tax deduction that's given you in the charitable remainder trust. So IRAs can work both ways. Then, as I just mentioned, you sell the asset tax-free. No capital gains tax, nothing. Then you receive income for the rest of your life. And in some cases, that can be thousands upon thousands of dollars. At death, the assets go to the charity. There's no estate tax due because the asset went to the charity. And then to make this really work, you replace the asset tax-free to your children so they will not lose anything out of this transaction. Now what I'm going to do is to show you an actual example before and after of how this works. Ellen is 65 years old. She has a $200,000 piece of property that she's spending about $2,000 in property taxes every year. It's bleeding her dry. She's receiving no income on the property. She wants to sell it. She bought the property back in the 50s for about $20,000. She needs income. She chooses to sell the property, and she does. She sells the property for $200,000. Now remember, she bought it for $20,000, so she has capital gains on $180,000. That's $200,000 minus what she bought it for $180,000. Now, assuming, like many seniors, she's in the income tax rate, 28% federal, 5% state, for a total tax rate of 33%. So she takes that $180,000 subject to capital gains and multiplies it by 33%, and she is paying the government a staggering $59,000 in capital gains taxes. What does that happen to her $200,000? Well, now it's down to $140,000 because she just had to pay the IRS money. Now she invests the income, the assets at 7% in today's economy. $140,000 times 7% is about $9,800 a year. She can do better, but she paid so much in taxes that dwindled down how much she has to invest. Then at death, there's more taxes. If she's in the 37% estate tax, her children within 9 months are going to have to pay $52,000 more in federal estate taxes. What does that add up to? The total taxes paid, $59,000 income, $52,000 estate. That $200,000 property has had to pay $111,000 of income and estate taxes. What does that leave for the heirs? $88,000. Look at the total of this. The government got $111,000, 56%. The heirs got